I am an acting professor of the practice at Cornell Tech and Cornell Law School. I'm also the faculty director of the Cornell Tech Board Forum, and I'm really excited to welcome you all here today, as well as our two guests, Jen Conway and Jessica McNamara. Jen Conway is the head of Davis Polk's executive compensation practice. She focuses on executive compensation matters, particularly in connection with business transactions. She also advises public and private companies on the design, implementation, and disclosure of equity and cash incentive compensation and retention programs and executive employment and severance agreements. Jen is a graduate of Georgetown School of Foreign Service and Columbia Law School. Jessica McNamara is senior counsel at IBM in Armonk, New York, where she leads the executive compensation and employee benefits practice and advises on a wide range of executive compensation and employee benefit issues involving qualified retirement plans, non-qualified deferred compensation plans, fiduciary governance, executive compensation governance and disclosure, and global equity compensation and executive compensation matters. Jessica is a member of the ERIC board, as well as a member of the board for the in-house benefits counsel network. Prior to joining IBM in 2007, Jessica was in private practice at law firms in New York City. I'm especially excited to say that Jessica is a graduate of Cornell School of Industrial and Labor Relations and of St. John's University Law School. Welcome to both of you. Thank you so much for joining us today. I'm excited for our discussion. To set the stage, I invited Jen and Jessica here today because executive compensation and benefits matters continue to be an area of high regulatory scrutiny and ongoing development. Today's discussion will focus on three hot topics. First, executive perquisites and personal benefits, or so-called perks, and the ongoing enforcement and audit by the IRS and SEC. We'll then turn to the Dodd-Frank requirement to claw back executive compensation in the event of financial restatements, which went into effect for all US listed companies in October of 2023, with a focus on what to do if your company is subject to a restatement. And then we'll turn our attention to the FTC's final rule banning almost all non-competes, which was released just 2 weeks ago and published in the Federal Register today. Again, with thanks in advance to Jen and Jessica, I will turn it over to Jen to now introduce our first topic.
Great. Thanks so much, Lizanne. Really appreciate having us. We've got a lot to cover today. So in the current environment that you mentioned, there's an increased focus on executive pay, and one area that's attracted a lot of attention from the SEC and the IRS is executive perks. The focus on perks isn't new. Back in the early 2000s, around the time of the Enron collapse and enactment of Sarbanes-Oxley, there was also a lot of focus on executive perks. But back then, the focus was on obviously abusive practices, like Jack Welch, who was CEO of GE with his $15 million New York City apartment and its $6,000 shower curtain, and the Tyco CEO's $1 million birthday party for his wife in Sardinia, all of that paid for by the company. Today, the issues are a lot more subtle. They often fall into gray areas that depend on judgment calls about whether an expense to the company should be properly characterized as a business expense, even if it does confer a personal benefit, or whether it should be characterized as a perk. These are very complicated questions, especially in the post-COVID era with a much more remote workforce. But the focus from the SEC and the IRS is real.
So, Jen, I know we've posted some slides in the chat for folks to take a look at. And so I want to make people aware of that. I also want to say that if you have questions, please post them in the chat. And now turning to, when you use the term perk, what does it mean? And does it differ from the IRS and SEC perspective?
Yeah, so first to sort of break things up, the SEC rules apply to people who are considered to be named executive officers of a public company. So that's the CEO, CFO, and generally 3 other most highly paid executive officers. They also apply to board members, and they require disclosure and quantification of perks in a public company's proxy statement for its annual meeting, subject to some de minimis exceptions. Again, this only applies to public companies. The SEC considers a personal benefit to be a perk unless it's integrally and directly related to the performance of duties. So, a laptop computer, clearly integrally and directly related. If it's a perk, then it has to be valued based on the aggregate incremental cost to the company. So basically the cost of providing the perk, which sounds simple, but it can actually be very complicated. In terms of examples of perks that need to be disclosed, the really big one is the personal use of corporate aircraft, and that's a huge focus for the IRS and the SEC right now. Family accompaniment on business travel, car and driver, personal security, financial, tax planning, executive physicals, country club memberships, relocation, commuting. These are all examples of disclosable perks. From a tax perspective, the IRS rules don't actually use the term perk. Instead, it's called fringe benefit. A fringe benefit is a non-cash in-kind benefit that's provided to an employee in exchange for services. The IRS is focused on whether the employer is properly reporting imputed income to the executive and withholding income taxes and Social Security. And the IRS is also focused on the corporate tax deduction that's being taken. Unlike the SEC rules, which are only applicable to public companies and only apply to the top of the house, the IRS rules apply to all businesses in public, private, even nonprofit, and they apply to all workers, not just directors and executive officers. So most fringe benefits are taxable, but there's an exclusion for working condition fringe benefits. And working condition fringe benefits are generally benefits that the employee would be able to deduct as a business expense if the employee was the one paying. And so working condition fringe benefits, again, easy ones are laptop, cell phone, a car that's used for a business purpose, a salesperson who has a company car. Questions arise from a tax perspective about whether an expense is properly characterized as a working condition fringe benefit or a taxable fringe benefit. And to be deductible, it needs to be ordinary and necessary within the meaning of the IRS rules. The IRS is also very clear that commuting expenses are not deductible. So ordinary and necessary is different from the SEC test of integrally and directly related to performance of duties. The SEC's bar is higher, but sometimes tax directors get nervous if you're reporting something in a proxy statement as a perk, but you're not reporting it to the executive as taxable income. And the executives kind of tend to get worried as well. So from both sides, there's a lot of focus on how you characterize something for disclosure purposes. If it is a taxable fringe benefit, you need to impute income based on the fair market value. So again, different than aggregate incremental cost. And there are some special rules for things like aircraft usage, a very particular methodology for valuing that actually results in a much lower value of taxable income than for perk reporting.
So, Jen, you've noted some areas in perks of recent and intense SEC and IRS focus. What sort of things are you actually seeing?
Yeah, so for the last few years, we've definitely seen a number of announced settlements of SEC enforcement action against companies for inadequate perk disclosure. And it's sort of hard to tell exactly what the facts are, but a lot of the focus is around, again, personal use of corporate aircraft, family member accompaniments on travel, and the difficulty of saying whether the spouse or other family member travel is integrally and directly related to the performance of duties. For the executive, it is, but it's the family member travel that often gets picked up. And more recently, we understand that the SEC has started an unannounced perk sweep. So a sweep is basically the SEC reaching out to a bunch of companies. From what we can tell, there's no discernible pattern among those companies, and asking them to produce documents and information about their disclosure of perks and also related party transactions. And again, corporate aircraft usage has been a focus. Sometimes companies sort of wonder, why is there so much focus on perks? The value, when you compare it to the overall magnitude of an executive's pay, is often, relatively modest. The issue is the SEC considers this to be an internal controls breakdown if perks aren't adequately reported. So, $100,000 of missed perk reporting can suggest an inadequacy of internal controls, which really does make it a much larger issue. From the IRS perspective, the IRS in February 2024 announced that it was stepping up its audit activity around the use of corporate aircraft and classifying personal travel as business travel. The IRS, again, is focused on not reporting imputed income to the executives and is also focused on the company's depreciation deduction. There's a much stricter rule and more limited ability to deduct depreciation if the aircraft is more used for personal than for business. The IRS has definitely announced that it's devoting more resources, and it's seen an uptick in the amount of perk reporting of corporate aircraft usage and proxies, not surprisingly with things like COVID, more use of private aircraft. But the IRS definitely is focused on it now and is focused on large companies and high net worth individuals.
Thanks, Jen. You've mentioned some gray areas in terms of whether something should be reported as a perk. Jessica, as an in-house lawyer, are you able to share any challenging questions that you've come across?
Sure. So, as you can see just from what Jen described, it's a pretty complicated area. You're dealing with two different standards, and you have a lot of things to keep track of. So the things that we found most challenging is when you have a mixed purpose trip. So you have a trip that may start out as business, but has a personal component to it. Sometimes that can be because the executive is going to an outside board meeting after a business trip, or because you have family joining on the business trip. So it's always a heavily fact-intensive inquiry to determine what should be considered a business expense and what should be determined to be a disclosable perk. And while most spousal and family travels tend to fall into the perk category, the call of whether it's an expense or personal business gets really interesting when spousal attendance is required, where they're expected to participate in presentations and to discuss some of what the presentation was about with clients or other dignitaries that might be at the event. And we have some really robust discussions about whether it should be a disclosable perk, whether it should be a business expense. And then the fun starts all over again when you have another trip that's similar but different facts. So that I think has been the most challenging.
And I'll say what I hear a lot of times from clients is my spouse did not want to go on this trip. This is an obligation. This is not fun. So, it's hard to say, oh, it's disclosed as a perk and you have to pay imputed income tax on it as well.
That is an unfortunate double whammy, I imagine. So Jessica, returning to this discussion, can you tell us a little bit about what sort of internal controls and processes that IBM has to ensure compliance with perk reporting and disclosure generally?
Well, what you've seen in the recent SEC investigations, as well as the IRS announcement on increased audit activity, is that record keeping and having a robust process is the key to ensuring you're accurately reporting your perks and your business expenses. We always have talked about, what are the right processes, and all of these are best practices, and they continue to evolve. So there are a lot of things we do for all of our perks, but since corporate aircraft is always the most focused on, I'll just spend a little time on what we do. So we have a clear written policy. That's number one, about who can use the corporate aircraft and for what purposes and what approvals are required. And the first level is always our approval. So our CHRO has to approve anyone who goes on the plane for any personal reason. The CEO, in our case, for security practices, we have him travel completely on the corporate aircraft for personal and business, which I think is fairly common at large companies just because of the security requirements. But outside of the CEO, as I said, the CHRO has to approve everybody's personal use, including to outside board meetings. Business travel does not need to be approved, but no matter what flight is taken, all our flights are reported in a dispatch system that automatically produces reports and has all of the details of the flight, the purpose, who it was, where the pickup was, the flight in time. So it's a very detailed record of each flight. But then on a monthly basis, that report is actually sent over to our officer services desk, and they review it, and then they check with the administrative assistant of the executive who took the flight to confirm all of the details. So that's sort of our first real check on the system. And then at the end of the year, when we're putting together, the tax return and putting together the proxy disclosure, HR, legal, and the officer desk and tax all get together again to review, what this record keeping has produced. So it is, several layers of approval and checking to make sure that we have it right. Because there's a lot of people to keep track of, more so on the business expense side, because not everybody has to have disclosable perks. And it's really important that the administrative assistants understand their role in this, because frankly, they have better records on the executives' travel sometimes than the executives do, because of everything that goes on. And while I focused on our aircraft process, this type of process is applied on all of our other perks. So ground transportation, personal security, and the like. We have several levels of approval and review to ensure that what we're keeping track of is an accurate record, so that we feel comfortable in our reporting that we've met our obligations. So the biggest takeaway for in-house and for anybody practicing for a company is that make sure your practice is robust, make sure it has several levels of review, and that it is auditable.
Thanks, Jessica. Those are great tips and best practices. And thank you also, Jen, for the discussion of perks. Let's move to our second topic, the Dodd-Frank clawback rules. Jessica, can you give a little bit of background about these rules, who they apply to, and what they require?
Sure. So the clawback rules took effect in the fall of last year and required every U.S. listed company to adopt a policy that provides for recovery of what's referred to as erroneously awarded compensation if the company is required to restate its financial statements due to material noncompliance with federal securities law. The amount that's considered to be erroneously paid is subject to recovery, not the entire payment. So it's basically the excess of what wouldn't have been paid had there not been any financial misstatement in the first place. So just by way of example, if the executive's bonus is based on revenue and the bonus is $100,000 based on $100 million in revenue, but it turns out the revenue really was $90 million and the bonus should have been $90,000, then the company will need to recover the $10,000 from the executive. This policy only applies to the Section 16 officers of a public company. And it's generally the top officers that you're thinking about, CEO, CFO, and it's usually your senior vice presidents or, a smaller group of senior vice presidents that have overall policy making roles. I guess some people would say it's a downside. The SEC would probably say, no, it's a good thing. It's a no-fault standard. So if the executive had nothing to do with the misstatement, they're still need to repay the excess compensation. And before Dodd-Frank, a lot of companies did have a clawback policy. So it's not really new to companies. What is new is the no fault. So many policies before, including ours, was if you had any involvement in a misstatement, or incorrect reporting, your compensation could be subject to recovery. So it's a meaningful change. In terms of the compensation that's potentially subject to recovery, it's only performance-based compensation that was received on or after October 2nd of last year. And received for purposes of the rule means that the performance goals were satisfied, not that the person actually got the money yet. So for most calendar year companies, it's the 2023 annual incentive bonus and other performance-based compensation for a performance period that ended at the end of last year or later.
Thanks, Jessica. Jen, when you and we all were having our initial call to prepare for this session, you mentioned that you had a client that was actually in the middle of dealing with a restatement. Did that restatement result in a clawback? And can you talk a little bit about some of the issues that you encountered?
Yes. So unfortunately, that client does have to recover some erroneously awarded compensation from its Section 16 officers, and we assisted in filing its proxy statement disclosing this to its shareholders. It's very early days of dealing with clawbacks in practice, so it was very much a learning experience. But in terms of the process, we found that it was very important to be thorough. There's real litigation risk here if the recovery is inadequate, and it's one thing to, to do everything right and the executive just won't repay, but it's another to just overlook something. So the rules are really complicated about what amounts are potentially subject to clawback. There's some things that are completely obvious, like a performance-based bonus or performance-based equity award. But there are other things like, a retirement plan contribution that's based on that bonus, or severance that's calculated in part based on that bonus, that are also subject to recovery. Given the complexity, it's definitely important to work with outside counsel here. For any company, a restatement is a very big event. It's chaotic and it's stressful. And just having an outside party that's been through it before, to the extent anyone has, because these are brand new rules, is very helpful. It's also helpful to make sure that you're actually correctly calculating what's subject to recovery. If the bonus or other compensation is just based on a GAAP measure, like the example Jessica gave, revenue, it's right out of the audited financial statements, it should be pretty clear. But for a non-GAAP measure, like adjusted EBITDA, there are a lot of adjustments that go into it, and it may differ in terms of the bonus calculation versus how it's calculated for the earnings release. It's a lot more discretion goes into it, and it's challenging because it's actually, the top management in some respects looking at recovering their own compensation. So important to have a direct line of communication to the compensation committee, important to really think about the spirit of these rules and how something would look if you did get a shareholder demand letter. In terms of compensation that's based on stock price or total shareholder return, that really presents the most challenges. I have not had to deal with that in practice, but the rules basically say that the company has to come up with a reasonable estimate of how the restatement affected stock price or total shareholder return, which is a really difficult task, and then has to document that and provide it to the New York Stock Exchange or NASDAQ, depending on where it's listed, and then disclose how it came up with the estimate. So it remains to be seen. Some people think that companies will hire firms that, have, for litigation, they, prepare estimates of stock price losses and things like that. But this is all sort of brand new. We're dealing with all this live for the first time now.
Thanks, Jen. How quickly do you have to recover the compensation?
So the clawback rules actually don't specify the timing for recovery. They just say that it needs to be reasonably promptly. But to the extent that it's possible, there are definitely benefits for recovering in the same fiscal year. If you don't, then there's disclosure in your proxy next year about the aggregate amount that remained outstanding at the end of the fiscal year. And also, if any amount remained outstanding for a current or former named executive officer, then you have to disclose if it's been outstanding for at least 180 days, identify the person by name and the amount that's outstanding. So you really do want to try to get this taken care of within the same fiscal year.
And what are the tax consequences of the clawback?
This is a very difficult question. So one of the most punitive elements of the clawback rules is that the amount that's recovered from the executive has to be calculated on a pre-tax basis. So if we take the example that Jessica gave, where the $10,000 is subject to recovery, even though taxes were already withheld from the payment, the executive only received the net after-tax portion, but still owes the full $10,000 back to the company. And of course, it's probably not going to be 10,000. It could be several million. So this can be a really problematic result for the executive. The executive might not have the cash. Part of it was withheld for taxes. If the compensation was paid to the executive and taken into income in the same calendar year that it's recovered, that's actually a really good scenario, because if you basically receive compensation and then give it back all in the same calendar year, it's actually treated for tax purposes as though it was never paid. It doesn't show up on a W-2, and it's not included in gross income on the employee's tax return. So one way that the company could recover in the same calendar year is just by reducing future pay. The problem with that, and that's a nice way to do it, because you can actually just, reduce the full gross amount. Taxes have already been withheld on what was erroneously paid. It works really nicely. The risk to doing that is if the executive leaves before the full amount has been recovered, then you've got this issue of, well, now you have to collect against a former executive. You don't have anything more to collect from, and that's going to be a lot more challenging. I just want to note that if you're going to do that, if you're going to hold back someone's salary, you probably need some sort of written agreement to do that, because most state laws just don't prohibit withholding an employee's salary without their consent. So, it's also just kind of helpful to have an agreement saying, if your salary doesn't prove enough, if you leave, then you're going to owe this back and you're going to have to write a check to the company.
So you mentioned that it's helpful if compensation is taken into income in the same tax year that it's recovered. But let's focus on what happens if it was taken into income in a prior year. Can you talk about that a little bit?
Yeah, so that's much, much harder. Fortunately, right now we're in the first year of clawback, so it's all, pretty much compensation taken into income in 2024. But, next year we'll almost certainly encounter the issue. So the problem is that the IRS will not let you go back and amend your tax return to exclude the income that was previously taken into account, but that you later repaid. The IRS generally also won't let you take a deduction in the year of repayment or any later year. So, in some respects, you're kind of out of luck for this full pre-tax amount that you repaid and don't kind of get any credit for the fact that you already paid taxes on it. There is a section of the Internal Revenue Code 1341 that allows an employee who receives income in one year and then repays it in a later year to be put back in the same position as if it had never been paid. So that's kind of, the same year. That's how it already works. But there's a really complicated test that needs to be satisfied, and it's definitely not clear that the relief would actually be available. And if the executive was involved in preparation of the restated financial statements, unless there was some kind of good faith error, then that relief is definitely not available to that particular executive.
Oh boy. Jessica, any practical tips from an in-house perspective in dealing with your new clawback policy?
Sure. So putting the policy in place, I think, was probably the easiest part. One of the issues that the legal community was really concerned about was whether executives who are subject to the policy would legally be required to repay the money because they never consented to be subject to the repayment provisions. We thought a lot about how's the best way to deal with this. I think there's arguments that the executive would be subject to it because it's required by law. And we have other certifications that are made annually on our code of conduct that says you agree to comply with IBM policies and agree to operate business in accordance with law. So, we could have relied on that. We thought about including a specific consent in the D&O questionnaire, but it seemed a little out of place there. So what we decided to do was to add language to our equity award agreements. In our agreements, which are publicly available with our Q, we filed in April, there's an accept your award section. And in it, we said that if you are or become subject to the recovery policy, you agree to be bound by the policy, including its repayment provisions. So it's a good consent. You're getting consideration for the consent. But then we also added the provision at the end that says you agree that this award and any prior awards, the provisions of cancellation and rescission and recovery as required by the SEC or the New York Stock Exchange, which were listed on the New York Stock Exchange, that you agree that those awards are subject to those rules. So we encompassed all the outstanding equity. Now, I think the obvious downside is for anybody who left, before they got this equity award. But what we did is we reached out to our former officers who are subject to the policy, explained the rule, and explained the repayment provisions. I mean, obviously, every company hopes they don't need to deal with this, but I mean, that is how we have tried to address that uncertainty.
Yeah, and I'll say just the disclosure requirement that I mentioned before, if the person was a named executive officer, of having to be actually named in the proxy statement if they don't repay, I think that can also motivate people to pay back.
Definitely.
Great, thank you. So let's move on to our final topic today, which is non-competes. I'm sure as many of you know, about 2 weeks ago, the FTC announced its final rule banning almost all non-competes with workers. And that rule was published in the Federal Register today. I would love to ask you, Jen, to discuss first this rule briefly and give us an overview.
Yes, absolutely. Before I do that, I'm just going to give one shameless plug for the webinar that my firm, Davis Polk, did on this topic last week. If you're interested in this topic, there's a much longer session on the Davis Polk website. It includes a panel of partners from our executive comp, antitrust, and IP groups. It's totally free of charge. You just have to register on the website and you can get free CLE credit, at least in some states. So I would definitely encourage anybody who's really interested in this topic to check it out. And then we also did an excellent client alert memo, and that's also on our website. So 2 weeks ago, the FTC issued a final rule that bans almost all non-competes in employment arrangements. We knew that this was coming. We were anticipating it, and we knew that it was going to be a broad prohibition, and it covers workers in any capacity. It does not just apply to employees. It applies to independent contractors. It actually applies to interns, volunteers. It's very, very broadly worded as applying to all workers. So there are a few limited exceptions, though, for non-competes with senior executives and also non-competes entered into when a business is sold. By its terms, the rule will go into effect 120 days after publication in the Federal Register. And so Liz Ann mentioned at the start of this webinar that publication actually just happened within the last few hours. It happened today. And that means that the rule is intended to go into effect on September 4th. That said, we knew the rule was coming and various parties were already gearing up for litigation challenges. The rule has already been challenged in 3 separate lawsuits, although I saw actually today that there was a stay on the Chamber of Commerce lawsuit and a request that it join one of the other lawsuits. So there are these lawsuits that are going on challenging the rule on various grounds, and there's a good chance that while the litigation is pending, the final rule will be stayed. Just to be clear, the rule is not in effect right now. The last point that I'll make is that the FTC rule has very broad application. It bans generally all new non-competes, and it actually voids existing non-competes with certain limited exceptions. It also defines non-compete very broadly to include things like forfeiture for competition, and it's got a concept of anything that functions to prevent an employee from accepting another position.
So, Jen, you mentioned the pending litigation. What is the likelihood that this rule actually goes into effect and remains in effect?
So definitely there are more details about this on the Davis Polk webinar, but I'll touch on it briefly. We expect a very hard-fought legal battle over this rule to play out in court. There's going to be multiple arguments that are advanced challenging the FTC's authority to issue this rule. Those arguments include things like a challenge to the FTC's authority, that the FTC Act does not actually clearly give the FTC rulemaking authority over competition law. There's a challenge called the major questions doctrine, which is a presumption by the Supreme Court that where there's an issue of vast economic and political significance, agencies need a clear statement from Congress that Congress intended to delegate authority to the agency. There will be challenges to the FCC's administrative process. that it didn't consider key factual issues that cut against its ideological position. There will be challenges to the constitutionality of the FTC itself, which doesn't actually allow the president to remove commissioners except under unusual circumstances. And there will be challenges to the rule's retroactivity. We think that there's a good chance that the rule will be stayed while those issues make their way through the courts. We think there's a good chance that the rule never goes into effect, but it's definitely important to take very close note of it because the state element of it is a totally different forum. New York State, which we'll get to, has proposed legislation that was vetoed by the governor at the end of December. But New York State is a place that's much less susceptible to kind of partisan gridlock. So, on the state level, there's much more momentum and ability to enact non-compete rules.
So with all of that said, let's turn and dive into some of the aspects of the rule in the event that we all become subject to it. So how does the rule define non-compete?
Yeah, so again, it's drafted very broadly. It would technically prohibit any term or condition of employment that either prohibits, prevents, or functions to prevent a worker from seeking other work once they've left. So this would cover a traditional non-compete where a worker commits not to go to a competitor for some period, and it provides for damages and injunctive relief, clearly covered. It would also include a forfeiture for competition provision. And this is something that you often see in parallel with a standard non-compete. If you compete after you leave employment, you'll forfeit some kind of payment. This is clearly prohibited under the rule as well. And then there's the function to prevent language, which is really a gray area. The FTC wants to prevent employers from entering into covenants that would function as a non-compete, such as an overly broad confidentiality agreement or a type of non-solicit that would basically function to prevent someone from taking another job. And I also wanted to note that the rule actually prevents a provision that would stop a worker from taking any job, not just a competitive job. So a retirement benefit that basically goes away if the employee works for a new employer, if the employee comes out of retirement, and that's not a terribly unusual thing, or goes away if you take a job other than government or nonprofit. That would also be prohibited under the new rules.
Thanks, Jen. One topic of note for many folks in New York and New York City is gardening leave. Does the rule prohibit gardening leave?
Yeah, so that's a really interesting question. And I think gardening leave means different things to different people. And people, this term is sort of an English term. The idea is, you're sidelined for a period, and so you spend the time gardening. So a garden leave period where the employee actually remains employed with full pay and benefits, but isn't really working and has restricted access to the company's premises and information. The FTC indicates in the preamble that this is actually okay. This is not post-employment. It's actually during employment, even if the employee isn't really working. But if the employee has actually terminated employment and is just required to sit out of the market, something that just says you can't take a new job for 3 months, that is clearly prohibited under the rules. Now, in the case of the garden leave that's permitted, where the employee basically, is in a notice period or is still getting pay, but not working, the problem is that if the employee basically just says, well, I'm leaving, there really isn't a way to stop that. In the US, you can't force somebody to be employed for the most part. You can say it was a breach of contract not to satisfy your notice period, but there isn't a way to really stop somebody from being an employee. The employee wouldn't get paid anymore, but the garden leave solution is not a perfect solution, albeit, at least it's something that still works.
Thanks, Jen. So another thing we often see is non-solicitation covenants, including ones that prohibit soliciting customers and clients. What about those types of agreements under the rule? What does the rule say about those?
Yeah, so the rule says that non-solicits are not per se banned. So the question is whether they function to prevent someone from taking other employment. And the rule gives examples of the term function to prevent and states that if a confidentiality agreement was drafted broadly enough to prevent using general knowledge, that could prevent an employee from taking another job using general knowledge and skills from employment. That wouldn't be protectable. Similarly, a non-solicit that basically would mean that the employee couldn't work, that would run into the function to prevent. And, I think it's, again, it's sort of a gray area. I mean, the employer may very well have a protectable interest in, not allowing the employee to solicit key customers, but you can see, a really broad, business that sort of covers the entire market in an area could effectively shut somebody out from working without the ability to solicit customers. And I think also, the way that customers are defined, that'll also be important. If you're talking about like a giant brokerage firm and you can't solicit any customer of the entire firm, that might be something that would function to prevent taking another job. You can't solicit, customers of the particular group and the people that you had confidential information about, that would probably be considered more reasonable.
Thanks, Jen. Who is actually covered by this rule?
Yeah, so I mentioned before the rule uses the term worker, and that clearly means employees, independent contractors, interns, volunteers, people who provide services to a business. It's intended to be a very broad functional definition covering anyone in a service provider relationship. Whether it covers partners of a partnership is not spelled out, but certainly, the type of service partner, a partner who's not really an investor, but providing services that we would expect would be picked up as well. And so there are other types of organizations that are actually not within the FTC's jurisdiction, and it's it's sort of beyond the scope of this to get into them, but certain banks and savings and loan institutions, federal credit unions, some common carriers, air carriers, I think some nonprofits are not covered by the jurisdiction of the FTC. And so the FTC just doesn't have authority over those types of workers, so it doesn't apply to those groups.
And Jen, we've had a question from the audience about whether there's any impact on the healthcare industry and doctors and the like. I don't know if you have any thoughts about that.
Yeah, well, certainly doctors in a for-profit enterprise, this would absolutely apply. And the customer patient non-solicit is a really big issue for doctors, especially because they tend to work on a somewhat local basis. So for-profit for sure. There's definitely some question in the space of nonprofit hospitals, again, because the FTC doesn't have jurisdiction over nonprofits, whether they're fully exempt from this rule. I think that's something that's still being determined.
Thanks, Jen, and thanks, Gabriella, for the question. I understand there's some limited grandfathering in the form of an exception for senior executives that applies to contracts entered into before the effective date of the rule. Who is a senior executive, and how should public and private companies be thinking about this definition?
Yeah, so the grandfathered senior executive exception applies to a very limited group. So one requirement, which is fairly easy to satisfy, is annual compensation that exceeds over $150,000. But the other requirement is that the individual has to be in a policymaking position. And this actually ties in with the Section 16 officer concept that Jessica mentioned in connection with the clawback rules. It's really, the FTC really drew pretty heavily off of the SEC definitions. And so refer to a policy-making function, and it's defined as the president, the CEO or equivalent, and any other officer of a business entity who has policy-making authority, or any other person who has policy-making authority for the business entity, similar to an officer. So like I said, it's very similar to that Section 16 definition. I think that you could potentially even read it a little bit more narrowly than the Section 16 definition, but I think for most public companies, that's sort of where they will view the senior executive definition to apply. And so, the senior executives, they're kind of hit from both sides. They're subject to the clawback rules. Their pay is subject to disclosure, tying it back to what I said about perks. And then they are part of the grandfathered group who can actually be subject to an enforceable non-compete. Private companies don't analyze their officers for Section 16 purposes usually, unless they're planning to go public or they have public debt. But usually when you're planning for an IPO, you start looking at the CEO and direct reports to try to identify who should be a Section 16 officer. And so that's likely the way that a private company would look at it as well. I had somebody once note, there's a rule that says you have to be an officer. You don't have to be an officer of the top parent company. You can be an officer of an affiliate or a subsidiary that's part of a common enterprise, but you have to actually have policy-making authority for the entire common enterprise. And again, that's the way that the Section 16 definition works as well. So clearly, the definition does not pick up people that you often worry about in terms of their access to proprietary information, like the top scientists or engineers or key salespeople. This is really focused on the C-suite.
Thanks, Jen. I believe in the rule, there's also an exception for non-competes entered into in connection with the sale of a business. Could you tell us a little bit about how that works?
Yeah, so that's a really important exception. If this rule ever takes effect, it's going to be one that we rely on a lot. So the proposed rule actually had a 25% threshold. So you had to be a 25% equity holder in order to have a valid non-compete in the sale of business context, which was just, that's an astronomical amount really, and would probably exclude almost everyone other than, maybe a founder from being subject to a non-compete. The final rule actually went in the opposite direction, eliminated that threshold requirement, and instead just states that the final rule does not apply to non-competes entered into by a person pursuant to a bona fide sale of a business entity, or sale of the person's ownership interest in a business entity, or all or substantially all of the business entity's operating assets. So that raises a question of how small an ownership might be sufficient. Is it so broad that you could cover somebody with just a small interest in equity of a public company? As the rule is currently drafted, it doesn't actually impose any sort of threshold, but there is a question of what's a bona fide sale of business. The FTC is likely to be concerned if they feel that this exception is being used to impose non-competes on a wide range group of employees. And, if this rule does go into effect, we're just going to have to wrestle with this complicated issue and figure out what does it mean to be a bona fide sale of business.
Right. So for example, does it have to be a sale of the entire business, or could it just be a sale of that quote unquote worker's interest in the business?
Yeah, so that's a really good question. I think we were expecting it originally to be an entire sale of business, but the final rule provides that it doesn't apply to a non-compete entered into pursuant to a bona fide sale of the person's ownership interest in a business entity. So on its face, it could be read to apply only to a sale of that person's interest. I'll note that the California non-compete statute, which we'll talk about a little bit later, also has an exception that applies to disassociation from a partnership or limited liability company. So basically sale of that person's ownership interest in those entities. And the FTC may have borrowed a little bit from that concept, but the preamble makes it clear that if you have kind of an ordinary call or free purchase right or mandatory redemption and termination, and this is something you really frequently see with a private equity portfolio company, that doesn't work. It actually has to be a right that's newly negotiated at the time of termination, but it is certainly an opportunity to get an enforceable non-compete.
Great, thanks. Let's turn to the California statute. California's non-compete statute has had a sale of business exception that's been around for a long time. Jessica, can you talk about how you see the sale of business exception used in California?
Sure. So we do a lot of acquisitions. Many of them include companies in California, and this non-compete is really critical to protecting the goodwill of the company we're purchasing. And so this exception, not having a threshold, is very important, to companies like IBM, but other companies and California, to ensure that companies in California are still attractive to be bought, so that you don't have somebody starting up a business in the next week in the same space. But that being said, it's very important to watch how the non-compete is structured. There are still a lot of rules about who it applies to. So it has to be somebody who's an owner of the goodwill. Case law has shown a 3% owner is somebody who would meet the qualification. But there is no limit in the statute, which is good. But you still have to look overall over the structure of who are the real owners of the goodwill that you can enter into a non-compete. It also has to be limited to the scope of what you're buying, the business that you're buying. So it can't be all of IBM, for example. It really has to be limited to that group, as well as the geography and time. So, case law around the country is developed to sort of have reasonable restrictions on geography and scope. That is a principle we find in California. So exceptions like this are exceptions that companies can work with and manage and still have the inorganic growth of acquisitions that can be successful for both the buyer and the seller.
Great, thanks, Jessica, for that perspective. Given some of the uncertainties we've talked about whether the FTC rule will ever go into effect, what do you think companies should do now to prepare in case the rule does go into effect?
Yeah, so I'm happy to start with that one, and Jessica, please definitely feel free to chime in. But we're not advising clients to rush out and start taking a bunch of action to comply with the rule, given all these litigation challenges. We don't think that you actually have to alter your existing practices right now. But we do think it's important to review your restrictive covenants and assess how broadly they apply and consider which ones you really need and what the impact of the rule would be on your organization if it does go into effect. And again, we've mentioned this a few times, there's always the state law issue that is really rapidly changing. States are in the process of enacting non-compete bans all the time. So, even if the rule doesn't go into effect, the climate has currently shifted, and a lot of courts have also become increasingly unwilling to enforce non-competes unless they're really narrowly tailored and protect the employer's legitimate business interests. So I think historically people sort of said, well, what's the harm of a really broad non-compete? We have a blue pencil. A blue pencil provision is something that says if this is found to be impermissibly broad, it's deemed to be reformed to be permissible. Courts are very hostile toward that sort of approach now. It's, you really need to be able to justify the legitimate business interest in having this scope. So that's something to look at and consider whether you have something that just, it would be very difficult to justify if it were challenged. When you enter into new non-competes, one thing that we're suggesting is possibly stating that they'll apply to the extent permitted by applicable law. And, you definitely want to make sure you've got that blue pencil provision. The original version of the FTC rule required you to reach out to everybody and tell them that their non-competes were unenforceable. That was not part of the final rule, but the California statute, which we'll talk about in a little bit, actually does now have a requirement to notify people. So in the case of a non-compete with someone who could be considered a senior executive, we're recommending that if you're entering into a new non-compete, you actually include an acknowledgement that the person is a senior executive within the meaning of the FTC rule. And in the case of sale of business, if it might apply, we'd also suggest including language that the non-compete is being entered into in connection with a bona fide sale of business within the meaning of the FTC rule. None of this hurts. If the rule doesn't take effect, then it's sort of, just additional ink, but doesn't have any sort of downside. And again, some of this might be useful at a state level as well. Other things that you can potentially do include possibly strengthening your non-solicit, your confidentiality, your IP covenants. But again, you have to be really mindful of something that's functionally equivalent to a non-compete. You can identify protectable interests and trade secrets and consider other methods of protecting these interests. Again, this is sort of challenging. It's much more difficult to prove. It's much more expensive. The trade secret angle is there, and it always has been, but it's probably going to become increasingly important. You can also include longer notice provisions or garden leave provisions that apply to your workforce, and you could do this in lieu of a more traditional severance arrangement. Again, garden leave isn't perfect, but it's something. And you can also just review your overall compensation and incentive plan structure and make sure that it's designed to give employees incentive to stay for a long term. So, possibly additional and longer vesting periods.
Thanks, Jen. We've mentioned state level non-compete statutes throughout this section. Can you discuss a little bit the current state of play among the states, particularly in New York and California?
Yeah, I'm going to do this super quickly because I want to give Jessica time to have the final word. So basically, the New York State Legislature passed a bill last year that would ban basically all service provider non-competes. Governor Huckle vetoed it at the end of last year and basically said that she was supportive of a ban, but it shouldn't apply to high-income workers. There should be an exception. It was really intended to protect low and middle-income workers. So we're expecting more legislative action in New York for sure, possibly in 2024. And then California, as I mentioned, basically adopted a statute that took effect January 1st, 2024, that makes it unlawful to enforce a non-compete against an employee in California, even if the agreement was signed when the employee worked in another state. And the employers were required to notify people by February 14th that they were subject to an unenforceable non-compete, and individuals now have a private right of action against an employer that enters into or attempts to enforce a non-compete that's otherwise void.
Great, thanks. I definitely want to give Jessica the last word on this topic. So Jessica, please.
So, I'll spare everybody probably the same concerns they've had within their own walls. But what I'll say is, Commissioner Khan, when she was announcing, the new rule, she mentioned several times that, California doesn't have a non-compete. And look at how innovative the companies in California are. And so we don't need the senior level or even an executive high income earner threshold as an exception going forward. And the things I think that were not properly considered were the fact that you have a lot of small companies outside of California who can't afford to save some of their technical talent if the behemoths in California can poach them, and outside of California as well, right? You have large tech companies that can pay to take the top engineers and the top scientists from some of their companies, and the smaller startups really have no ability to save them. So the innovation from that space and the protection of the IP and confidentiality in the startup world is at risk. But I would even say, for all companies who have trade secrets and IP, the commissioner noted that, well, you can still enforce those through confidentiality and IP agreements. But what she didn't, or maybe she took into account and didn't put a lot of importance on, is once the IP walks out the door and someone starts work the next day working for somebody, the only real method is an injunction. And if the injunction isn't granted, there's no equitable relief that can get the IP back. So the damage is done, it's too late. And the non-compete is really a nice way to have someone sit out for a period so their information becomes stale. And for some type of technology, even if somebody doesn't disclose, for example, IBM's confidential information, the IP that they've been working on is part and ingrained in the work that they do. So even if they don't talk about an IBM strategy, the information or the work that they've been doing at the company is naturally going to get disclosed in their future work. There's two other things I'll say that I wish had been given more consideration, is that the Northern District of California's docket is heavily overloaded with IP and confidentiality lawsuits so it's not as if is going to, or I should say, we'll see how the law develops here, but my suspicion is that it's going to be too late in many of these scenarios for people to protect their IP. And then finally, one of the things that was not mentioned when talking about the California companies that work very well without a non-compete is the fact that they actually got into trouble with the DOJ and antitrust because they had agreed on no poaching agreements to not take their top technical talent from each other. So it was Google and Apple and Intel and Adobe, and that was a long time ago, right? Now it's over a decade, but this is a real business concern that we need to be able to protect our IP and trade secrets, and a reasonable rule, even if it applies to a level of the technical talent that you need to protect, is one that certainly we'd be in favor of, but I think is much more palatable to the business community than one that just bans all non-competes going forward, except for sale of business.
Thanks, Jessica. That's great. That's great perspective. I guess we'll all stay tuned to see how this unfolds in the courts. Thank you both, Jen and Jessica, for your insights today. And thank you to everyone in the audience for joining us. This has been a great program, and I really appreciate you taking your time. So thanks, everyone.
Thanks so much.
Thank you.
Take care.